Hello everyone, I'm delighted to take you to London today. Let me introduce you to Vitruvian, a private equity firm, part of the Altaroc Odyssey 2024 vintage. Founded in 2006, Vitruvian is a leading name in growth equity and growth buyout in Europe. Stephen Byrne, partner at Vitruvian, welcomes us into his office for an exclusive conversation with Louis Flamand, our Chief Investment Officer.
Hi Stephen, thank you very much for taking the time to meet with us in Vitruvian's offices in London. So I think we first met around 10 years ago when I first invested with Vitruvian. It was Vitruvian 3 on behalf of the institution I represented before joining Altaroc. It's a pleasure to interview you today. Could you please first introduce yourself and maybe share with us the key milestones of your successful professional career?
Thank you. Well, first, good to see you. Thank you for the time. As you mentioned, I've been here for quite some time now. I joined almost 18 years ago, so the week of first close on the first fund, really at the beginning of Vitruvian. Before that, I started my career as a technology investment banker. I was with Goldman Sachs from 98 to 2003, both here in Europe and also in the US. I then joined General Atlantic, which is a big US software and services investor, and was with them from 2003 to 2007, before joining the team here really at the very beginning of Vitruvian.
And what is your role today at Vitruvian?
We all wear multiple hats at Vitruvian. We don't believe in being siloed. So along with my colleague Tassilo, I look after our financial services effort, and along with my colleagues Sophie and Jack, I look after our horizontal software effort. In addition, as the firm has grown, one of the things we've tried to do is each of the partners has taken on some aspect of the organization to allow the business to scale. So one of the things I look after is what we call our investment strategy group, helping support our origination effort, making sure we use CRM effectively, think about the channels to market and how we build our theme lines so that we make sure that we're always filling the top of the funnel.
Could you please introduce your firm, Vitruvian, and its history to us?
Certainly. So the firm today has come a long way in the 18 years I've been here. So today there are 200 people in the team, of which about half of those are on the investment side. We have 10 offices. We're managing approximately 20 billion in AUM. The current fund, Fund 5, is a 7.3 billion euro fund. So that's where we've gotten to today, and we're very pleased with the support we've had over 5 funds from our investors. But if you go back to how we got started and why we got started, and the story really hasn't changed much, is trying to take a thematic approach to find growth within the mid-market. And when we first got started, we really felt there was a gap in the market of capital servicing those exciting mid-market companies that had tremendous potential, many of them on a global scale or global opportunity. And we really wanted to support that with our fund. And the strategy really hasn't changed from there. We continue to focus on that mid-market growth area and really using a very thematic approach to find those opportunities.
At the heart of your investment strategy is the concept of dynamic situations. Could you please explain what it is?
Yes. For us, that is really a framework of how we find quality growth within opportunities. So one of the interesting things about the markets we operate in, and we're sitting here in Europe, so we can use Europe as a good example, economic growth is not going to create the sort of growth we're looking for, 15, 20, 30% organic growth. Economic growth alone is not going to do it. What you're looking for is segments of the market that are really growing quickly, and that is driven by change. Something is changing within that market, and it could be driven by technology change, regulatory change, demographic change, but something is changing within that segment of the market that's creating a growth market within that sector. That's not enough, however. The framework also needs to think about the quality of the business model that will benefit from that growth. When you're growing quickly, you need to be able to scale your business, but you also need to remain flexible, which is one of the reasons why, as you're aware, we obsess about asset-light business models that grow very effectively and scale well, and are creating an element of defensibility, barriers to entry around them, so that they can be the winners from a changing market. The danger of a changing market is you need to be on the right side of that change, and you need to be able to react to it. And our dynamic situations framework really is an aid memoir for us internally, focusing on finding those good segments of the market with high growth, and then obsessing about finding the business models and companies that will benefit over the long term from that growth. And we call that our dynamic situations framework.
Could you please explain your thematic sourcing approach?
Indeed. And that is really key to how we operate, because it isn't enough for us to find a pocket of growth in a market. For that to be relevant for us, given we're fundamentally long-term investors, and we assume that the people who buy businesses from us will also be long-term investors, that needs to be a long-term change. It needs to be a change driver for 10 years, not a sort of short-term movement in the market. How do you understand what is causing that change and whether it will endure? You have to really get under the covers of, well, if it's a regulatory change or a technology change, do we understand it? Do we understand where that's leading? We really need to pull the thread on that theme over time and understand who the winners and losers are going to be from that changing market. So to give you a sense, in any fund vintage, we typically deploy capital against between 10 and 12 themes, and we have 2 or 3 that are in the incubation, exploration stage for the next fund. But these are themes that tend to live for a very long time, and we deploy multiple investments against those themes. And it is one of those things where you get rewarded for spending time and understanding, because you begin to see more and more opportunities against that theme. What we try and do for the newer themes is we have a forum called Hackathon, where the senior team members bring together some of their emerging ideas, emerging opportunities, and all the senior team, the PMD level, so that's our partners and managing director level, get together and discuss, is this something where we have pattern recognition against an existing theme? Is this a new theme potentially emerging in its own right? And it allows us to constantly be keeping fresh our existing themes, but also looking for those new themes that might not be relevant for this fund, but might be relevant for the fund after.
And why do you prefer senior investment professionals at Vitruvian to focus on 2 to 3 subsectors as opposed to being specialized in a single sector?
There are multiple reasons why we think that works for us. One is we're quite anxious to avoid silos, where if you have the flexibility to recognize that certain segments of the market at any point in time might be less interesting than others, if you only have one segment of the market to invest in, it is very hard for you to remain flexible and say, okay, this segment of the market is running hot, overvalued, or not creating the opportunities. If you have multiple hats that you're wearing, you can spend more time on the other things. The other aspect is there is real read across of patterns that we see in businesses. So if you take something like our marketplace thematic, where we've deployed capital in many areas, but actually that cuts across traditional industry verticals. So you really have to be willing to follow the thread of that theme wherever it leads. And another example is cyber, where our trust and security in a digital world has been a theme that we've made 8 investments, but those investments have covered vertical software, horizontal software, financial services, consumer internet. So we think that that ability to remain flexible and think about things as a theme rather than me with my financial services only focus allows us to find the best opportunities. And it keeps resources within the organization flexible, that we can move team members around to where we find the best opportunity. Has been candidly particularly relevant in the last few years, where certain segments of the market, if you take a period like 2020, 2021, certain segments of the market were running very hot. We, and thanks to our investors, have been given a tremendously flexible mandate. We were able to use our flexibility to spend time on themes that weren't exposed to that hot area of the market.
What has been the long-term performance of your funds?
I'm pleased to say we've had good and consistent long-term performance. We believe we are in the upper tier of performance over the long term. And part of that is really down to the segment and type of investment we make, where we're looking for businesses growing 15, 20, even 30% organically. To a certain degree, if we have chosen a good market with long-term growth and a business model that stands to win in that environment, one of the opportunities we have is we do not need to add financial risk to that investment to make a decent return. So we can let organic growth drive most of our returns, and historically, if you look, that's where most of our returns have come from, is backing pure organic growth. So we do use debt, obviously. However, we don't have to stretch it to make the investment work. And that gives the company the flexibility to grow quickly, but also grow safely. And fundamentally, we think that the key to consistently good returns fund after fund is not just having great money multiple winners on the one hand, but also maintaining a very, very low loss ratio. And we think if you do the two things together, you maintain that consistency of performance. We're very fortunate that we've had investors who've been with us really since the very beginning. We owe it to them not just to give them good returns, but to do it fund after fund after fund. And one of the nice things about our business model is because we don't have to layer in that financial leverage risk, we use it, but we don't stretch that. It means that our loss ratios are very, very strong.
Could you please elaborate on two of your investments, explain how you source them, how you've created value with them, or how you are currently creating value with these companies?
Much of what we invest in are B2B businesses, often that people have never heard of. So if I may, I'll give two good examples that generally have a bit more of a brand and would be known. I'll begin with Just Eat, which is one of our older investments, but was very successful for us. And this was a marketplace model for food delivery. And obviously that sector has become very well known and a very big sector. When we first invested, it was an interesting opportunity to unpick because we're a growth investor. We do growth equity and growth buyouts. We do not do venture. But this was a business that wasn't making money. And you really had to unpick, and credit to the team who did spend the time unpicking. What we were actually able to see was the underlying economics of the business model when they were established in a region or country were very, very strong. But there was a J-curve of investment required for each new region or each new country. And one of the things I think we were able to bring to bear there was an understanding of that and a willingness to allow the company to continue to accelerate that J-curve investment. So obviously a very successful investment. We then were able to take that business public. It was a very successful public company, and we were able to manage our exit over time to also make sure that we made a good return within the public domain. A more recent one and a more live one would be something like E-Z-Paque and Flowbird. And this is one of the privileges of working in our segment of the mid-market is when we invested first in that business, that was somewhat of a Nordic champion, active in really 10 markets, but tremendous organic growth, good technology, and has grown to be present, I believe, in about 80 markets today. It's become a very large business. And with the merger with Flowbird, has gone from being a mobile payments provider, really for parking, to being a full parking and mobility solution business with the full suite of offering both on the technology and on the services side. So a business that's really gone from being a true mid-market company, as we discussed, into one of the global leaders within its field. And it's a real privilege for us to play our part in the development of a business like that.
Who are your typical investors and what is their average commitment?
As you can imagine, we're quite discreet about our investors. We have the range of pension funds, endowments. We've been very fortunate to have investors that have stayed with us fund after fund. We would like to think we've repaid that with good performance. It's become a very global investor base too. When we started with the first fund, it was probably more North American based. First time fund, there are more investors in the US who tend to spend their time in that area. Over time, just as Vitruvian has become a truly global organization, so too has our investor base really evolved with us and become a truly global investor base.
What's your perspective on the current market? Is it a good time to invest?
One of the wonderful things about being in the mid-market is it's opportunity rich. So there are always businesses and there are always opportunities. One of the other things we have with our strategy is we're not actually tied to economic growth. We are really looking for those change drivers, those dynamic situations within a market that are creating growth that is disconnected from economic growth. That allows us to continue to invest, frankly, through all cycles. And we do think that it is key to continue to invest throughout all cycles. So we continue to see opportunities. And as I mentioned, a very opportunity-rich market allows you to be selective. One of the things I'm particularly grateful to our first fund investors, and we've maintained since, is the flexibility they gave us. They did not restrict us to a certain shape of deal or a certain sector. And the way we repay that trust is by using that flexibility to navigate around segments of the market that will either be more opportunity-rich or, frankly, be mispriced. We're trying to buy very high quality growth at attractive prices. Not every segment of the market at any point in time will offer that. However, if we stick true to our themes, we can focus on those themes where we're finding that opportunity. So I'm personally quite excited about, for example, Fund 5. It's got off to a good start. We have a good pipeline. We're feeling good about the overall landscape. However, to a certain degree, we should be able to continue to deploy and continue to find those good opportunities irrespective of the overall economic environment.
How do you see the private equity industry evolve over the medium to long term?
So several things are happening which are quite exciting. One, we're a growing asset class. I think there is more effort now going on, and perhaps you were a reflection of that, to make sure that that opportunity is available to a wider group of investors. Some people refer to it as the democratization of private equity, and we're really seeing that across the market. Yes, we are an illiquid asset class, we are a certain type of investment, but actually we are becoming more attainable for a wider range of investor types. So that's exciting. That continues to add to the growth in the market. I think increasingly we're becoming global, and we're forced to become global. The markets change quickly. There are news stories out of Asia, out of the US, that change the technology and the growth landscape. So I do think that we're in a market where the private equity industry is becoming more global in terms of its vision of what it sees in the world, but also capability to support our companies becoming truly global businesses themselves. And then finally, as the markets become more sophisticated, I do think that capital alone isn't enough. One of the things that David and Adrian, who run our value add program, have done very well is given us the right sort of resources and support for our portfolio companies that, ironically, even though they're in all sorts of different industries, the growing pains of businesses often have very strong similarities from different businesses to others. Hiring people, scaling operations, scaling technology, and building that value add infrastructure has become very important to us in terms of what we offer to our portfolio companies. But I think that's true for the private equity industry overall, where just having capital probably is no longer enough. You must be delivering alpha, both in terms of sourcing those interesting opportunities, but also in helping actually the performance of the investments you make.
And final question, Stephen. I heard that you actually speak French. Peut-être une dernière remarque en français?
Bien sûr, il faut toujours dire merci à nos investisseurs, non seulement pour votre support, mais aussi pour votre confiance en nous. Et j'espère que ce fonds, c'est le début d'une relation longue et bien sûr profitable pour vous.
Thank you very much, Stephen, for presenting Vitruvian to us today and sharing your insight on the market.
My pleasure. Thank you very much.